Welcome to the Research Desk. What if I told you the 2000 dot-com crash, the 2008 global financial crisis, and the 2020 COVID-19 lockdowns were, well, the exact same event?
I mean, economically, they absolutely weren't.
Right, not economically, not historically, and certainly not in how they felt to the people who actually lived through them. I mean, if you were on a trading floor during the dot-com crash, it felt like the death of an idea. It was this agonizing realization that the infinite promise of the internet just could not suspend the laws of financial gravity.
Yeah, and if you were managing money during the global financial crisis, it was entirely different. It felt like the death of a system. It was this sudden, really terrifying realization that the invisible plumbing of global capitalism was just fundamentally broken.
Exactly. And then if you navigated the COVID crash, well, that felt like the death of normality itself, an exogenous biological shock that just halted the physical gears of human commerce. So, yes, they had completely different triggers, different villains, but underneath the daily headlines and, underneath all the human panic, there is this rigid, mathematically inescapable architecture that governs all of them.
Which is where our source material for today comes in.
Right, because through the lens of Shannon entropy, every single one of these crises follows the exact same four-phase life cycle. Phase 1 is compression, Phase 2 is fracture, Phase 3 is disorder, and Phase 4 is recompression. So my side of this debate is straightforward. The mathematical sequence is identical, the severity of the trigger is irrelevant. Financial crises are not these random acts of God, and they aren't unique historical snowflakes. They are measurable physical processes. By measuring the Shannon entropy of daily market returns, we can definitively track when a system loses its ability to process surprise, and we can map the exact sequence of its destruction and rebirth.
Okay, and this is where I fundamentally disagree with your framing. You treat this like a theoretical physics equation, and the sequence itself is not the entire story. In fact, focusing solely on the sequence is precisely how investors lose everything. I represent the perspective that the duration is the true variable.
But the math.
I do not dispute your math. The mathematical sequence is identical, yes, and the Shannon entropy equation never changes. But the danger, the real danger, lies in looking at that elegant math and assuming the lived experience of the market will be uniform. The true variable, the element that actually defines whether institutional fortunes are built or destroyed, is the duration of these phases.
Well, duration is just a byproduct.
No, duration is everything. If the mathematics of a financial crisis are identical, we have to answer a fundamental question. Why did the dot-com fracture take 31 agonizing months to reach the bottom, while the COVID fracture shattered the global equity markets in exactly 23 days? The phases are the same, sure, but the clock speeds are violently different. Telling an investor who lost their capital in a 3-year grind that it was mathematically identical to a 3-week flash crash is frankly functionally useless unless you understand the architecture of the system.
I wouldn't call it useless. It provides the map.
A map without a scale. The nature of the compression dictates everything about the real-world fallout. The complexity of the consensus determines the velocity of the destruction. Narrative compression, structural compression, simple compression, they unwind at entirely different clock speeds. My position is that fracture speed is perfectly inversely proportional to compression complexity. Misunderstand that architectural reality and you will buy the dip exactly when you should be liquidating your portfolio.
Okay, all right. To understand why the clock speed changes, we first need to define exactly what we are measuring, and we need to strip away all the financial jargon. We are measuring surprise, not the subjective emotion of human surprise, but the mathematical quantification of it using Claude Shannon's information theory.
Right, the dice analogy.
Exactly. Imagine a 6-sided die. If the die is perfectly fair, every time you roll it, you were surprised by the outcome. You don't know what it's going to be. That is a state of high entropy, maximum disorder. Now imagine the die is heavily loaded to roll a 6. You roll it 100 times and it comes up 6, 99 times. You are no longer surprised. The outcome is entirely predictable.
Minimum surprise.
Right. That is a state of low entropy, minimum surprise. So, when we apply Shannon entropy to the daily returns of an index like the S&P 500 or the NASDAQ, it tells us exactly how many different outcomes the market is producing. When entropy is low, the market becomes a monoculture. It produces the same small, positive return day after day after day. This is phase 1, compression. Consensus is absolute.
Everyone believes the exact same thing.
Right. And conversely, when entropy is high, every day is a violent surprise. The market is producing wild swings, up 4% one day, down 5% the next. Nothing is predictable. This is phase 3, disorder. A financial crisis, stripped of all its economic narratives, is literally just the transition from phase 1 to phase 3. From minimum surprise to maximum surprise. And the chaotic violent path between them is phase 2, the fracture.
Okay, so let's apply that. Let's look at the actual data.
Let's do it. By measuring this mathematically, we can begin our forensic proof with the longest phase 1 in modern market history, the dot-com bubble. From January 1997 to March 2000, we witnessed 38 months of pure narrative monoculture. The NASDAQ rose 288%, and during this period, the entropy of NASDAQ daily returns fell relentlessly. By February 2000, the 60-day entropy was below the 8th percentile.
The 8th percentile.
The 8th percentile. The market had ceased to produce diverse outcomes. If a company had .com in its name, it just went up. The compression was absolute.
Right, but look at the architecture of the specific compression. The .com compression was an architectural marvel of human psychology, precisely because it lacked any physical constraints. It was a purely narrative compression.
Meaning what, exactly, in your view?
Meaning there were no deeply nested derivatives. There were no complex leveraged chains winding their way through shadow banks. There was only a story. And the story was that the internet represented a completely new paradigm. The traditional valuation metrics, like price-to-earnings ratios, were obsolete. It was all about eyeballs, right? Capturing market share at any cost was deemed the only rational behavior.
Which it obviously wasn't.
Obviously. But the simplicity of that narrative is what made it so powerful. It drew the entire landscape, from retail day traders clicking away in their basements to massive institutional pension funds, into the exact same trade. But the profound danger of a purely narrative compression is that it relies entirely on human belief. And belief is a fascinating, stubborn mechanism when you subject it to market forces.
Well, it blinds people.
Completely. You mentioned the 8th percentile entropy reading in February 2000. Look at the traditional volatility metrics from that exact same moment. The VIX was hovering in the 20 to 25 range. It was totally moderate.
Right, volatility watchers saw nothing.
Absolutely nothing alarming. They missed the fragility of the system because volatility only measures the magnitude of the moves. Entropy saw what volatility could not. The returns were diverse in their size, maybe, but they were entirely homogeneous in their direction. Everything was moving together. The system was incredibly fragile precisely because everyone was crowded onto the exact same side of the boat, even if the boat was rocking slightly.
The most perfect encapsulation of that specific fragility was Cisco systems. Let's just look at the mathematics of a single asset at the peak of a narrative compression. In January 2000, Cisco briefly became the most valuable company in the world. It reached a market capitalization of $555 billion, and it was trading at 196 times trailing earnings.
196 times. Let that sink in.
It's absurd, but the valuation multiple is actually not the most striking data point. The Shannon entropy of Cisco's daily returns was sitting at the 3rd percentile.
Wow.
The 3rd percentile, think about that physically. The returns had collapsed into a single, inescapable pattern. The stock went up every single day by a small, predictable amount. The market had entirely stopped processing the possibility of loss for this specific asset, and within 24 months, Cisco lost 86% of its value. That 3rd percentile entropy reading was the exact fingerprint of a system that had compressed to the point of imminent failure.
It was a coiled spring.
By looking at the price-volume divergence, or PV divergence. To put it simply, PV divergence measures the difference between what prices are doing and what trading volume is doing. Throughout 1998 and 1999, price entropy and volume entropy were perfectly aligned. Both were low,
It was a genuine consensus.
Everyone was buying, everyone was holding.
Right. But in January and February of 2000, the PV divergence turned sharply negative. Volume entropy fell far below price entropy. This is the ultimate distribution signal. Picture a crowded nightclub. The music is getting louder and the line outside is getting longer. That is the price continuing to rise, pushing the NASDAQ to its final peak. But the VIPs are quietly slipping out the back door.
They're cashing out.
Yes, the institutional volume was quieting down. The crowd was eagerly buying the top, while the institutions were quietly and systematically stepping back. They stopped participating in the monoculture.
And then the narrative broke. March 2000. But this is exactly where your insistence on identical sequences fails to capture the reality of the market. This is where the physics of the timescale become absolutely vital to survival. The dot-com fracture, phase 2, is the longest fracture of the 3 historical crises we are examining today. It took 31 months from the NASDAQ peak in March 2000 to the ultimate trough in October 2002.
It was a long unwind.
It was psychological torture. A 31-month unwind defies the modern expectation of a swift market correction. Why did it take nearly 3 years to reach the bottom? Because unwinding a story is a fundamentally psychological process. A narrative compression requires individual human beings to abandon a belief system they hold passionately.
They have to admit they were wrong.
Exactly. And belief erosion is vastly slower than mechanical liquidation. A margin call forces you to sell immediately, regardless of your conviction. The computer liquidates your account and it is over in seconds. But a narrative crisis gives you the illusion of choice. You can hold on. You can read a bullish analyst report and convince yourself that the fundamental thesis is still intact. This is why the 31-month fracture was not a single vertical drop. It was an agonizing, rolling cascade of sub-fractures. Each one was specifically designed to break a different layer of true believers.
Well, the timeline of those sub-fractures perfectly illustrates how a system processes the death of a belief. Let's look at it. The initial crack occurred in March and April of 2000. The NASDAQ dropped 25% in just 3 weeks. Entropy immediately surged from the 8th percentile to the 60th percentile. The monoculture was shattered. The loaded die finally rolled a 1, and the market was stunned.
But they didn't give up.
No, they didn't. The market partially recovered. The buy-the-dip narrative was still deeply entrenched. Investors genuinely believed this was just a momentary correction in a permanent paradigm. It took until September and November of 2000 for the second wave to hit. This was when the actually profitable technology companies, the Ciscos, the Intels, the Microsofts, finally broke. They could no longer defy the gravitational pull of the broader sector's collapse. Entropy pushed to the 75th percentile.
Another layer of believers wiped out.
Right. Then came March and April of 2001. A broader economic recession was officially confirmed. This initiated the third wave, dragging down the non-technology stocks that had previously seemed immune to the dot-com fallout. Entropy hit the 85th percentile.
It just keeps rolling.
And then, the exogenous shock of September 11th layered on top of an already fracturing system. The market closed for 4 days and reopened with entropy at the 95th percentile. And finally, in the summer and fall of 2002, the final wave arrived with the WorldCom and Enron accounting scandals. This is crucial because it wasn't just tech failing anymore. Trust in corporate governance itself collapsed. If you cannot trust audited financial statements, you cannot value any company.
Which drives entropy to its absolute maximum.
Precisely. The NASDAQ finally bottomed out at 1,114, down 78% from its peak. Each sub-fracture killed a layer of belief. And throughout this entire 31-month phase 2, entropy continuously oscillated between the 50th and 95th percentiles. It never settled into a sustained state of maximum disorder, because every partial recovery temporarily recompressed the market around a new, false consensus that the bottom was finally in.
That oscillation you describe, that is the signature of human denial. It is the sound of a market desperately trying to reconstruct a broken narrative. It was only after that final plunge in October 2002, driven by the sheer exhaustion of the accounting scandals, that the market finally surrendered to phase 3, disorder.
The capitulation.
Yes. For 5 months, from October 2002 to March 2003, entropy remained pinned above the 80th percentile. There was no consensus whatsoever. Multiple narratives fought for dominance. Some believed the tech wreck was finally fully priced in. Others were paralyzed by the geopolitical uncertainty of the impending Iraq War. Others focused on a weakening broader economy, while still others saw corporate earnings finally beginning to base. It was pure informational chaos. No single story could gain traction. This is the defining characteristic of Phase 3. It is the exhaustion of belief. The market admits it has absolutely no idea what anything is worth.
Which seamlessly leads to Phase 4, recompression. It began in March 2003 and lasted roughly 5 months. Paradoxically, the actual invasion of Iraq resolved a massive source of geopolitical uncertainty. At the same time, the Federal Reserve held interest rates at 1.25%. Corporate earnings stabilized, a new narrative slowly began to win the competition, the recovery plus cheap money narrative.
And the entropy drops.
Rapidly. As this new consensus formed, entropy fell rapidly, dropping below the 25th percentile by August 2003. The market had successfully processed the massive surprise, expelled the old dot-com narrative, and organized itself around a new set of facts. The 4-phase life cycle was complete. It took 79 months from the beginning of the compression to the end of the recompression. The mathematical sequence proved absolute.
The mathematical sequence held, I'll grant you that. But the cognitive reality is that dot-com proved human belief takes 31 months to fully erode. So what happens when the belief isn't just in our heads but mathematically hard-coded into the structural plumbing of our banking system?
The GFC.
This brings us to the global financial crisis, from 2006 to 2009. If the dot-com bubble was a crisis of narrative, the GFC was a crisis of structure. The Phase 1 compression began in January 2006 and lasted 18 months. It was significantly shorter than the dot-com compression, but it was infinitely more dangerous because the compression existed in multiple interlocking layers of the financial system simultaneously. I want you to walk through the math of this specific compression because the signature of the GFC Phase 1 is arguably the most terrifying data set in modern financial history.
It really is. It is terrifying because the market was producing an illusion of absolute stability while literally standing on a foundation of nitroglycerin. Look at the credit spreads. The spread between BBB-rated corporate debt and AAA-rated sovereign debt compressed to historic, irrational lows. Credit entropy was near zero.
Explain what that means physically.
Let me translate that into physical reality. The bond market was fundamentally failing to differentiate risk. A highly leveraged subprime mortgage pool was being priced with the exact same certainty as United States government debt.
Which is insane.
It is. Look at the volatility. The VIX fell to 12.5. Realized volatility completely collapsed, which gave quantitative volatility targeting strategies the mathematical green light to leverage up to unprecedented levels. Look at housing. Home prices were rising uniformly across the entire country. The geographic entropy of housing returns was near zero. Regional economic differences ceased to matter. A house in Nevada and a house in Florida were both appreciating at the same relentless pace.
It was a perfectly synchronized bubble.
And look at the equities. Stock-to-stock correlations compressed. Everything moved together in one unified direction. By July 2007, the entropy of the S&P 500 had fallen to the 4th percentile. The 4th percentile. The market was producing a near-perfect monoculture of outcomes. The narrative was simple but structurally reinforced. Housing is safe, subprime is contained, and the Federal Reserve has your back.
But here is the most crucial difference between 2000 and 2007, and it is revealed by your own PV signal. During the dot-com bubble, the smart money diverged. You had the negative PV divergence, remember? The institutions quietly stepped back. In the GFC Phase 1, there was absolutely no divergence.
Zero.
Both price entropy and volume entropy were incredibly low. They were perfectly aligned. Think about what that actually means on a trading floor. This means there was no smart money divergence visible anywhere in the data. The institutions, the prime brokers, the hedge funds, they genuinely believed the narrative. They were completely captured by the monoculture. This is the most dangerous PV configuration in the entire framework.
Because no one is manning the radar.
Exactly.
When even the smart money is compressed, the system loses its early warning mechanism. The consensus was so dense, so impenetrable, that contradictory information literally could not be processed by the market. By June 2007, the ABX index, the synthetic subprime mortgage index, had already begun a steep decline. The underlying reality of the mortgage market was deteriorating rapidly.
But the equities didn't flinch.
They didn't even blink. The S&P 500 entropy showed absolutely no response to this data. The equity market was entirely blind to the credit signal. The information existed. It was right there in the ABX. It was showing up in the repo markets. It was visible in commercial paper rates. But the equity market's entropy was so low, the narrative membrane was so thick, that the system literally lacked the informational bandwidth to incorporate the danger. The market had lost the capacity to process reality.
Which makes the onset of Phase 2 in August 2007 so incredibly instructive as a mechanical process. The fracture began when the French bank BNP Paribas froze 3 of its investment funds on August 9th. They explicitly cited a complete evaporation of liquidity in certain segments of the U.S. securitization market. They essentially said, "We cannot price these assets, therefore we cannot allow you to withdraw your money."
The ultimate red flag.
Entropy immediately surged from the 4th percentile to the 89th percentile in just 6 weeks. The illusion of stability shattered. The loaded die rolled a 1. The transition from minimum surprise to maximum surprise was initiated. It was initiated, but again, look at the timescale. The GFC fracture took 13 months. 13 months is an unusually slow unwind for a structural crash. Margin calls are supposed to be fast. Algorithmic liquidations are supposed to be immediate. So why did it take 13 agonizing months to get from BNP Paribas freezing funds in August 2007 to Lehman Brothers filing for bankruptcy in September 2008? Because of the leverage. Because the leverage was deeply, invisibly nested. This was not a narrative that people slowly gave up on over coffee. It was a Jenga tower of interlocking dependencies. The financial system had to meticulously deleverage institution by institution, layer by layer. One layer had to completely shatter, trigger a margin call, and force the liquidation of an asset before the rot of the next layer was even exposed to the market's view.
The timeline of that mechanical unwinding is a masterclass in structural contagion. Let's trace the dominoes. In August 2007, following the BNP Paribas freeze, we saw the quantitative funds blow up. Because these funds used the same math and the same historical correlations, when one sold to cover losses, it dropped the price for everyone else, triggering their automated alarms, forcing them to sell too.
A robotic fire sale.
Exactly. That was the first major entropy spike. The system absorbed that blow, and for a moment, the broader market thought the damage was contained to the esoteric world of mathematical trading. But the rot was simply moving to the next structural layer. In March 2008, the contagion reached the prime brokers. Rumors of insolvency led to a run on the bank at Bear Stearns, culminating in its collapse and forced sale to JP Morgan. That was the second massive entropy spike.
And again, the market tries to recompress.
Right. One, the market attempted a partial recompression in April and May. The narrative shifted to the worst is over. The Federal Reserve had intervened, a major bank had been rescued, and the system felt secure. But the structural deleveraging was not finished. It moved to the bedrock of the mortgage market itself. In July 2008, Fannie Mae and Freddie Mac, the massive government-sponsored enterprises holding trillions in mortgage risk, began to collapse and were put into conservatorship.
The third strike?
That was the third entropy spike. The foundation was gone. And then the final fail layer was exposed. On September 15, 2008, Lehman Brothers filed for bankruptcy, the ultimate counterparty failure. Entropy exploded from the 60th percentile to the 98th percentile in 5 trading days. The fracture was complete. The sequence holds perfectly.
The sequence holds, but the 13-month duration was perfectly dictated by the structural complexity of the compression. And that 98th percentile reading ushered in a Phase 3 disorder that was unlike anything seen in modern financial history. From October 2008 to March 2009, the market existed in a state of pure information chaos. The very survival of global capitalism was a daily debate. Imagine living through that.
It was unparalleled.
The TARP legislation, the massive bank bailout, was proposed, failed in Congress, causing the Dow to drop 777 points in a single day, and was eventually modified and passed. Automakers begged for bailouts. Prominent voices seriously proposed the nationalization of the entire American banking sector. Central banks engaged in globally coordinated interest rate cuts. The insurance giant AIG required a massive government rescue to prevent a domino effect of counterparty defaults. The daily returns of the S&P 500 were a portrait of utter madness.
Just wild swings?
The index would rise 4% one day, fall 5% the next, and rise 3% the day after that. There was no trend, there was no narrative, there was no consensus on what a bank was worth, what a mortgage was worth, or what money itself was worth. Entropy was pinned above the 85th percentile for 5 consecutive months.
And right at the climax of that disorder, at the absolute nadir of human sentiment, the mathematics revealed the most profound signal in the entire framework. Let us stop and look closely at March 2009. Pause. The S&P 500 is plunging toward the devil's number, 666. The world genuinely believes the global financial system is ending. It is a monoculture of despair. Price entropy compressed dramatically because the entire market was producing the exact same downward outcome. But volume entropy did something extraordinary.
The divergence.
It spiked to the 72nd percentile. The PV divergence reached positive 64 percentage points. I want to emphasize how staggering that number is, positive 64. This means that while prices were collapsing in a uniform, predictable manner, the trading volume was highly diverse, spread out across many sessions and many actors. Someone was systematically, quietly, and relentlessly buying the market day after day.
The VIP is coming back in.
Let's reverse the nightclub analogy from .com. The building is on fire. The retail public and the panicked institutions are sprinting out the front door, liquidating at any price. But the true smart money, the billionaires, the massive sovereign funds, they are quietly coming in the back door, systematically buying up the property for pennies on the dollar. It was the loudest accumulation signal in modern market history. It was the exact opposite of the .com distribution signal. And almost nobody saw it, because almost nobody was measuring the entropy of volume. They were only watching the terrifying headlines and the falling prices.
That plus 64 divergence is the mathematical proof that phase 3 is not just chaos. It is the laboratory where the next cycle is engineered. The smart money recognized that the structural deleveraging of phase 2 was complete. Every nested derivative that could blow up had blown up. The forced selling was over. What remained was simply the emotional panic of phase 3, and so they bought.
And phase 4 began.
Within weeks, phase 4 began, the QE recompression. From March 2009 to August 2009, a new narrative emerged from the ashes, and it was the most powerful narrative central banking had ever constructed. The government will print whatever it takes. Quantitative easing. The Federal Reserve stepped in as the ultimate buyer of last resort, purchasing trillions of dollars of distressed assets. As that narrative took hold and proved credible, entropy plummeted. It fell from the 85th percentile down to below the 25th percentile in just 5 months. The market formed a new consensus. The system recompressed, and the longest bull market in financial history was born out of the math of that recompression. The GFC life cycle took 41 months from start to finish. Structural compression unwinds methodically.
Which brings us to the third major crisis, and the most extreme test of the framework. The COVID crash of 2020. This is where the mathematical sequence proves its universality by demonstrating the exact same life cycle at a 10x clock speed. We begin with phase 1, the AI and Fed compression. It lasted just 5 months, from October 2019 to February 19, 2020. Entropy was sitting at the 11th percentile. The VIX was at 14.
Very calm.
The narrative was impenetrable. The Fed put is infinite, the trade war with China is resolved, and artificial intelligence is the undisputed future of productivity. It was the exact same monoculture signature as 2007 and 2000. Low entropy, low volatility, high confidence. But unlike the previous crises, the PV divergence was showing a mild divergence. It was slightly negative.
It suggested quiet distribution by some institutions, perhaps anticipating a localized disruption in global supply chains. It was not as violently blind as the 2007 census, nor was it the massive distribution signal of 2000. It was a market that was heavily compressed but perhaps slightly uneasy beneath the surface.
And then the surface broke. Phase 2. The fracture began on February 20, 2020. I want you to reconcile this speed with your rigidest sequence. If the dot-com fracture was a 31-month marathon of psychological pain, and the GFC was a 13-month demolition of structural leverage, the COVID fracture was a 23-day execution.
23 days.
Entropy exploded from the 11th percentile to the 94th percentile in 23 trading days. It remains the fastest phase 2 in modern market history. The S&P 500 fell 34% in 33 calendar days. This is the defining contrast of the entire data set. I put the question to you directly. If the mathematical phases are identical, if entropy governs the life cycle perfectly as you claim, what physical mechanism allows a market of that massive size to completely shatter in 3 weeks? Why did it not take months or years like the others?
The speed does not invalidate the sequence. It simply reflects the input. The answer is found in the architecture of the compression itself. The 2020 market was a simple compression. There were no deeply nested collateralized debt obligations, slowly toxifying the balance sheets of prime brokers over 18 months. There was no complex psychological belief system about new valuation paradigms that needed to be debated and eroded over years of earnings calls. There was one dominant narrative.
The economy is fine.
The global economy is functioning smoothly, and the Fed will provide liquidity. And that single narrative was instantly invalidated by one exogenous shock. A global biological pandemic required a synchronized, immediate physical shutdown of human economic activity. One brutal, undeniable fact killed the entire consensus overnight. There was nothing to debate. There was no sublayer of leverage to discover. The cash flows of thousands of businesses literally went to zero in a matter of days. Airplanes stopped flying, hotels emptied, restaurants locked their doors. Simple compression dictates a violent, immediate fracture because the mechanism of destruction requires no human interpretation.
Exactly. The physical fact overwrote the market psychology, and because the fracture was instantaneous, the system moved directly into phase 3, disorder, from March 24th to June 2020, a 3-month period of extreme entropy. The market was completely untethered, entropy pinned above the 80th percentile. We saw violent sector rotations that defy traditional financial modeling.
The work-from-home trade.
Technology stocks skyrocketed as the work-from-home narrative took hold. Energy stocks plummeted, with oil futures famously trading at negative prices, a mathematical impossibility under normal market conditions. Healthcare surged on vaccine hopes, while travel and hospitality equities were treated as distressed assets. 4 massive macro narratives were competing simultaneously: a V-shaped recovery, a prolonged second Great Depression, a devastating second wave of the virus, and the miraculous timeline of mRNA vaccines. The market moved sideways violently, trying to price in outcomes that range from utopian technological acceleration to literal civilizational collapse. It was a pure manifestation of maximum surprise.
But just as the fracture was accelerated, the resolution was equally swift. Phase 4, the fastest recompression on record. July and August of 2020, just 2 months. The competing narratives of Phase 3 were suddenly overpowered by a unified, unassailable consensus. Federal Reserve liquidity, combined with unprecedented fiscal stimulus, paired with tangible progress on vaccine development. The monetary and fiscal cannons were fired simultaneously. The narrative won. Entropy collapsed below the 25th percentile by August. The bull market violently resumed. A complete 4-phase entropy life cycle. Compression, fracture, disorder, recompression, was executed flawlessly in just 7 months. 10 months if you count the lead-up. The math never changed, the sequence never altered. Only the clock speed adapted to the simplicity of the shock.
Which brings us to the present application of this entire framework. The Timescale Theorem is not merely a tool for historical autopsy. It is a mechanism for real-time navigation. We now have a 4th data point that proves the architecture dictates the speed. The April 2025 tariff shock. Let's look at the data from just last year. From January to March 2025, the market entered a phase 1 compression, 3 months of low volatility. Entropy was sitting at the 14th percentile. The VIX was back down to 14.
The Magnificent Seven.
Exactly. The Magnificent Seven technology stocks dominated all index returns. The narrative was monolithic. AI will save everything. Productivity is permanently elevated. Margins will expand forever. It was the exact same signature we saw before .com, before GFC, and before COVID. The market was tightly compressed, mathematically vulnerable to any surprise. And then came phase 2. On April 2, 2025, the president announced the sweeping tariff policy on social media, a massive structural shift in global trade dynamics, announced without warning. The fracture took exactly 5 trading days. Entropy surged from the 14th percentile to the 78th percentile. The S&P 500 fell 12% in a straight line.
5 days. This was the fastest phase 2 we have ever recorded, and it perfectly validates the timescale mechanics we've been debating. If COVID was a simple compression, April 2025 was a trivial compression. There was no physical shutdown of the economy. There was no mechanical unwinding of deeply nested leverage. There was a single policy announcement that fundamentally altered the earnings calculus for multinational corporations. The market didn't need to debate the psychological merits of a paradigm, nor did it need to wait for counterparty defaults to spread through the shadow banking system. It simply ran the math on the new tariff regime, adjusted the discounted cash flow models, and repriced the entire equity landscape instantly. One tweet, one policy, instant repricing.
And the recovery?
Following that 5-day fracture, the market entered phase 3 for about 4 weeks. Disorder. Competing narratives emerged regarding tariff negotiations, specific sector exemptions, and the potential for policy reversals. And then phase 4. A 6-week recompression in May and June as the tariffs are negotiable, not structural narrative won the day. The entire life cycle completed in roughly 5 months.
When we place these 4 crises side by side, the empirical evidence solidifies into the Timescale Theorem. It provides a precise mapping of how the nature of the compression dictates the duration of the fracture. The dot-com bubble was a narrative compression, driven by pure human belief. The mechanism of the fracture was belief erosion, layer by layer, because true believers hold out the longest. The duration of phase 2 was 31 months. The global financial crisis was a structural compression, driven by nested leverage. The mechanism of the fracture was mechanical deleveraging institution by institution. The duration of phase 2 was 13 months.
And COVID?
The COVID crash was a simple exogenous compression. The mechanism was a single consensus invalidated by a single undeniable physical fact. The duration of phase 2 was 23 days, and the April 2025 event was a trivial policy compression. The mechanism was a single policy shift causing instant algorithmic repricing. The duration of phase 2 was 5 days. The pattern is mathematically unmistakable. Fracture speed is perfectly inversely proportional to complexity compression. The more interlocking, the more psychological, the more deeply nested the compressed system is, the longer and more agonizing the unwind will be. The simpler the compression, the faster the system breaks.
And yet notice what happens in the second half of the life cycle. Across all 4 of these wildly different crises, the durations of phase 3 and phase 4 remain remarkably stable. Whether it's the dot-com aftermath, the post-Lehman wasteland, the COVID lockdowns, or the tariff negotiations, phase 3 and phase 4 always take roughly 2 to 5 months each. Why? Because while the mechanism of destruction, the fracture, is dictated by the specific architecture of the market, the mechanism of recovery is dictated by human cognition.
Human psychology has a speed limit.
Exactly. The search for a new narrative, the processing of maximum disorder, the testing of new hypotheses, and the eventual formation of a new consensus, these processes operate on the fixed timescale of human psychology. It takes a group of human beings roughly the same amount of time to process a trauma, debate the future, and agree on a new reality, regardless of whether that trauma was a banking collapse or a biological plague.
The mechanical timescales of destruction vary wildly. The human cognitive timescale of recovery is constant.
This realization shatters the fundamental assumption that underpins modern financial education. Every finance textbook assumes that each crisis is a unique sovereign event. They teach the dot-com crash in a chapter about irrational exuberance and valuation metrics. They teach the GFC in a chapter about financial engineering, collateralized debt obligations, and regulatory failure. They treat COVID as an unmodelable black swan event outside the realm of financial theory. They view them as fundamentally different phenomena, but the data proves they are exactly the same phenomena operating at different clock speeds.
The entropy life cycle is absolute.
Yes. Compression always leads to fracture. Fracture always leads to disorder. Disorder always leads to recompression. The sequence never changes. The phases never skip. The mathematical signature of surprise is identical. The only variable is the timescale, and that timescale is entirely determined by the measurable complexity of the compression.
If the next crisis follows this exact same life cycle, and we have 4 definitive data points proving that it will, then the entire paradigm of risk management must shift. The question is no longer the futile exercise of asking, will there be a crisis, or what will be the catalyst? The catalyst does not matter. The trigger is just the spark that finds the dry kindling. The only questions that matter are, what type of compression are we currently in, and therefore, how fast will the fracture be? By measuring the entropy of the market, we can quantify the stored energy of the system. We can estimate the physics of the response before the trigger is even pulled.
It's about practical survival.
Exactly. The practical implications of this framework translates abstract information theory directly into tactical survival. Rule number 1, you must define the compression. If you identify that the market is in phase 1, entropy is below the 20th percentile, the derivative is flat or falling, the market is a monoculture, you know a fracture is a mathematical certainty. Phase 1 always ends. But more importantly, you must diagnose the type of compression. If we are in a market dominated by a single powerful belief system, say the belief that artificial intelligence will exponentially increase corporate margins without limit, you are in a narrative compression. That tells you that when the fracture comes, it will not be a 3-week flash crash. It will be a dot-com-style multi-month erosion of belief. It will be a slow, grinding destruction of capital that lures in dip buyers only to crush them. You can prepare for the duration of the pain simply by observing the nature of the consensus.
Which leads directly to the most critical operational rule of the framework. Never fight phase 2. When the entropy derivative turns sharply positive, the fracture has officially begun. The narrative is breaking. At that exact moment, the specific trigger that caused the break is completely irrelevant. Do not try to analyze the news. Do not try to determine if the market is overreacting to a specific headline. The response is determined by the stored energy of the phase 1 compression, not the spark that ignited it. Once phase 2 begins, liquidity is vanishing and outcomes are diversifying violently.
Do not buy the dip.
Do not buy the dip. The investors who bought the initial 25% dip in the NASDAQ in April 2000, thinking they were getting a bargain on a momentary correction, proceeded to lose another 60% of their capital over the next 2 years. The math dictates that you must wait for phase 3, and phase 3 is not for deploying capital. Phase 3 is for research. When entropy is pinned above the 80th percentile, when daily returns are swinging wildly without direction, there is no edge in taking large directional positions. The market is in maximum disorder. It is searching for a narrative. This is the time to analyze balance sheets, to read earnings reports, to identify which companies have the cash flow to survive the chaos and lead the next cycle. You study the board, you don't play the pieces.
You wait for the alarm, and the alarm is the price-volume divergence. This is the single most actionable signal the framework provides. When price entropy remains tightly compressed because everyone is panicked, the news is universally terrible, and the market is marching downward in uniform despair, but volume entropy suddenly becomes highly diverse, the game is changed. The smart money has finished their research, they have identified the bottom. They are quietly and systematically accumulating assets across multiple sessions while the retail public is indiscriminately liquidating. That plus 64 PV Divergence signal in March 2009 was the clarion call of generational wealth creation.
And it will happen again.
The mathematics guarantee that signal will appear again, when the current cycle exhausts itself. And when that accumulation signal is confirmed and entropy begins falling from its phase 3 highs, you have officially entered phase 4. A new narrative is forming. The market is recompressing around a new reality. This is the highest conviction entry point in the entire life cycle. The forced selling is over, the disorder is resolving, the smart money has already built their foundation. Positioning aggressively alongside the emerging consensus in phase 4 is how you capture the massive upward trajectory of the next cycle. It is the beginning of the next great compression.
We can debate whether the pure mathematics of Shannon entropy or the structural architecture of human behavior is the true driver of market reality. But the synthesis of the two is undeniable. The equation driving all of this, the negative sum of the probability of an outcome multiplied by the base 2 logarithm of that probability, never changes. But the substrate of the market changes constantly. It might be dot-com narratives, it might be subprime mortgage derivatives, it might be a global pandemic, or it might be geopolitical tariff shocks. The human stories we tell ourselves change, but the life cycle of surprise does not.
The underlying physics are immutable. You cannot predict the earthquake, but you can measure the tectonic pressure, and the pressure tells you the magnitude. This is the Research Desk, officially signing off.